in America under $2 million of EBITDA that's worth it, people would have high-fived you because that was the point of view. $2 million was a whole lot of money to me, but not to anyone else. So that was, for some of you who may know, Harvard Business School started a class on ETA. 2 years later, Stanford's got one. Now the top 25 business schools have one. Financing. So it used to be, and this kind of goes in with the other, if there wasn't $2 million of cash flow, the deal became almost impossible to finance. But then the only people that could finance deals even at 2 million were people that had fancy credentials, because if you weren't sort of private equity inked, people didn't want to trust you with the $6 to $10 million that you would need to go buy a business of that sort. And so maybe you could over equitize it, or if your real estate holdings were large enough, you could bet some of your real estate. But as a venturing entrepreneur 12 years ago, there was really no way to do this. If I go back 3 years, I think the groundswell was happening 3 years ago. So you have like the Roland Frasers that are getting more popular, Cody Sanchez's, Alex Hormozzi's. And although all of them have sort of unique angles, them plus the business schools, plus the buy then build, plus a lot of other things were just pushing this industry quicker, more people, more interest, etc. But here's the key: the lending market changed. So there's been a program called the SBA 7A program that's been around forever, but most banks, it was almost like training a dog to be a cat. So most banks are not cash flow lenders; they're like assets. That's why you guys are investing in real estate. So I got some dirt, I got a building, it's worth $1 million. Loan me 90% of it, and if I'm wrong, you get the building. Everybody's good. What about a software business that's doing, $250,000 in seller's discretionary earnings? Well, I want 5 times for that, and that's $1 million. But if I'm wrong and the bank lends on it, they get 0. So 3 to 5 years ago, there were very few, if any, banks that would do the loan. It wasn't that the program wasn't in place. It wasn't that the SBA wasn't backing 90% of the stuff. Just the banks wouldn't do it. Now, fast forward to 3 years ago, Live Oak Bank, Byline Bank, Huntington Bank, and even some of the banks you guys do business with are doing tens of hundreds of millions of dollars of SBA loans. And if I fast forward to today, it's wide open because you guys have capacity in your investors already. But let's just say I rolled out of bed at 40 with no money. There's 4 or 5 investing funds that will put up all the equity the bank will need. There's probably 10 banks that'll do any reasonable deal. And there's thousands of people who are looking at these deals currently. So I took a little bit longer to get into that. But I would say right now, there's not a better time to do deals because no matter how much equity you want to put in or how you want to structure it, the capital markets have never been more friendly to these deals.
Got it. That makes sense. Did that make it that prices have gone up a little bit higher versus the risk, or the risk has gone up higher what it was before?
Well, I think it's just really hard to find a good deal. So it's almost like a binary thing. You guys are really, you get it, right? If your cousin has that prime building, downtown New York or Philly or Chicago, it doesn't matter that your capital stack is a little wonky and maybe the pricing is weird. If you get a nice seller note or a piece of property that wouldn't normally trade, then you win. Or if, some people are driving for dollars and you find something that's mispriced, then you win. It's the same thing in this market where our prices inflated a bit because more people are looking. I would say a bit, but not so much that I think it turns the return outside of a spectrum that you do the deal.
Got it.
If that makes sense. So I think, and I think the markets are also calming down in terms of, it hasn't hit yet, but a lot of companies are not being able to keep up their 2022 numbers year to date 2023, and that's becoming harder and harder to hide. And so what you're seeing is companies that are having to get more realistic with the valuations. And I would also say you're seeing more seller financing. Last year, you'd see sort of maximum 10, 12%. Now you're seeing 20 and 30%, which is more like the kind of deals that I was doing 8 and 9 years ago.
Got it. So there kind of things are normalizing in a way.
Yes, very much so.
Post COVID. So like if you go a little bit macro, how do you think of risk in general? So from someone whose job is to risk mitigate, how do you think of risk in general?
Well, I'm going to assume I'm talking to real estate guys. So,
Yeah.
And forgive me if I'm missing anyone. So, let's say you own 100 doors in apartments, right? And your risk tolerance for that is normalized because you've done that 10 times. Your friends have done it hundreds of times. You guys are in masterminds about it. So that level of risk is, call it 1, not 0, but 1, not high. Nobody's pulling their hair out. Now let's go to you buying artificial intelligence companies, pre-revenue, with highly volatile, sort of staffing and ability to actually get people in the door. So you went from like level 1 risk to like, oh my God, you're too crazy to jump this chasm risk, right? So let's move some of these deals out. If you're running real estate, you're paying HVAC people, you're paying property management, you're paying plumbing, you're paying security potentially. These are all companies that you're cutting checks to every single week. So I would almost argue the best risk-adjusted opportunities lay adjacent to your real estate holdings. If any of you guys are concentrated in the city, you could potentially buy a company that could service all your real estate properties in that city. And all of a sudden you bought an operating business to extend your investment portfolio without really taking on any more risk. You know, one of the things I tell people about sort of what business to buy, Elliott, well, figure out the check that you cut every month that you hate spending the most and don't have a good alternative to. And that's the one I would look at. And so I don't know how the HVAC, plumbing, and the home services, but I think for real estate folks, that's a natural progression.
Got it. And so within like the framework of due diligence, what are some of the risks that you focus on to kind of like in terms of like a framework wise, how when you look at a business, what's your approach?
Great question. So there's 3 areas of diligence broadly, and this goes back to my private equity days. And I think even if you're doing, you know, I was doing $100 million deals when I was on Wall Street, but the same holds true for a 10 or a $5 million deal. So there's financial diligence, there's commercial diligence, and then there's operational diligence. And that's sort of in the business side of things. There's legal diligence and insurance diligence, and there's risk associated with those, but you can beat those out of deals at a known price. The first is financial. Why? If the person says they're doing $1 million in EBITDA and it's $500,000, the seller's probably not going to sell at a multiple of $500,000. There's no deal, even if the operation and the commercial are either the best ever or the worst. So you have to start with financial to make sure that's solid. And I'll double click on financial in a second, Jay. Then there's commercial. Commercial, just think sales. Commercial is how does the company connect with the outside industry such that you can take advantage of the sales and the growth in that industry, or your business is hindered from doing so, right? So it's how sales, how's the industry, what's the industry outlook, all those kind of things that help you on a commercial side. How am I going to go to market? Then there's operational. Operational's inside the walls of the company. Who's the management team? How structured are they? How's accounting? The mission critical jobs that the business must do to deliver cash flow. How strongly are they set up to do that? So the framework for me is financial, commercial, and then operational. And then I would say the fourth area, and if you go to my website, I have a whole hub full of war stories. can I use strong language, Jay? Or
Go for it. Yeah, yeah, absolutely. Yes.
it's just bullshit, right?
Yeah.
Like it's people trying to run a play, people trying to get over on you, people that have spent 30 years in their business and they need $5 million to go to their vacation home and Telluride. And they're saying, hey, I wonder if Curtis or Adam or Darren or Jay is going to be the sucker that's going to pay me $5 million for $1 million asset.
Yeah.
And I call them war stories. I'm probably going to rebrand them with red flags. I think it resonates better. End of the day, it's just wonky stuff. Like a lot of people will try to play games in between cash and accrual accounting. A lot of people will play games with inventory. A lot of people, since valuation is a function of cash flow, they do things like, okay, well, Jay, let's say this is a real story. So a management team was sticking with a company that was for sale. The owner was a serial entrepreneur that had been doing different companies, probably 3 already. This was his 4th. He was going on to his 5th. Well, the good news was the management team was sticking around. So my client was so happy about that. Cash flow was solid. We're good to go. But after I finished financial diligence, I realized these were like 15-year digital marketing experts that were taking $60,000 of salary from the company. That's not market. You couldn't replace those people for $60K a piece. Those were $150,000 jobs. So on day one, if those guys quit, you were going to have $300,000-$400,000 of new costs in the business, which you should not have paid a multiple on those dollars. Not to mention, you guys are owners. If you're working with the serial entrepreneur 3 times, he sells, you have no equity in this thing, but you're probably going to be able to get some equity in his next thing. How long before you just go to his next thing where you have some equity instead of working for some dope that you haven't known for 15 years? So structurally, the concept of this management team didn't make sense. Or I can tell another story of someone who saw that their revenue and cash flows are falling off ahead of going to market to sell. So they made an acquisition they call strategic and necessary and all this kind of crap. It really was to hide the fact that the core business that had been around the whole time, that had the history that people wanted to see and was in the industry people liked, was having a hard time selling. So they bought this new one that had like short-term growth, like think like Vine or one of these social media apps that had a great 6-month run. You know what I mean? And so when you look the two of them together, it looked like steady growth. But really, you wouldn't have bought either one. One, the growth wasn't sustainable, right? But it was the only one growing. The other one was deteriorating and wasn't sustainable on its own. So people play a lot of games like that. I put that all under the umbrella of bullshit.
Yep. So how do you capture those things? How do you, obviously you go through the financials, you're going to hear the story. How are you going to try to look for inconsistencies in the storyline? But sometimes you have this compressed period where you have to like do due diligence and get stuff done. And then, you're kind of battling, maybe you're talking directly to the seller, maybe you're going through brokers. How do you navigate that? How do you set it up front in the first conversation with the seller that you're going to go deep and you're going to, do this stuff? Because I think, and I heard you talk about this before, where your negotiation is essentially very critical up front, and how you prep the seller to go through this exercise, whether he has a broker or not.
Sure. So let's talk about a broker deal and a non-broker deal. In a broker deal, a seller has gone to an agent, someone to a real estate agent, but that person has prepped them on what to expect, has put together some materials for the business to go to sale, has sent the information to their lists. And so when you send them a letter of intent with, hey, I need 90 days to close the deal, I need 45 days of due diligence, I need access to all your files, they're already used to it. Now, maybe the broker didn't give them 100% of how challenging it can be. Maybe they gave them 80, but you're sort of in the ballpark. When you're dealing with a seller that doesn't have representation, I think you just need to prepare them for, you don't get a $5 million check just getting out of bed, you know? So if you want to sell, the price of selling is going through due diligence. I'm dealing with a seller now who got angry with me, verbally angry on the phone, and didn't want to answer questions and was quite painful. And he didn't have representation. And I kind of told him, like, hey man, like, my client can buy your business today without my okay, but he's not going to. I have work that I do, and I've been doing this for 15 years. I'm going to do it. And on the other side of my work is your $5 million check. But if you don't want to answer the questions, that's fine. But you're putting your $5 million check in question. I can't help you with that decision. He called me back and said, and this made perfect sense to me. He's like, Elliott, I've been doing this for 30 years. I've never had anybody that had the capacity or ability to ask me these questions. So I'm struggling with it, but you're right. If I want to get paid for my business, I have to go through it. So let me kind of check myself. But you're going to have more work to do if the seller doesn't have representation. But I think the simplest way to put it is, look, if you want the check, you got to do the work.
And it's so important. It's interesting. I met a guy who at a conference who's speaking on short-term rental management, and he had $100 million. It was like a 10 million EBITDA company, and he was telling me, like, my conversation was around small business acquisition, and he was like, oh yeah, I went through this process, a few months ago, and it just didn't go through, didn't go well. And I asked him, it's like, well, why didn't you sell? That was like last year was a great time to sell. And he said, well, they were like giving me a hard time, even though I prepared my business, they were asking me too many questions. I said, what questions? They said, well, my kids' salaries and my cars. And I'm like, dude, you got a 10 million EBITDA company. What are you talking? You're going to get paid. You're going to get a big check. What are you messing? And he was still offended. That was the surprise in my head, was I look at his face and you could tell he was offended by it, which, he should know better that, you should know better. And so it was interesting.
It's also and it's expensive to make these choices, right? So it's Jay, 5 minutes ago you asked me to talk about risk.
Yeah.
Right. And it's very hard to do that in absolute space, right? Because I'm looking at 7 people's faces, and I'm sure you guys interpret risk differently. However, what I'll tell you is that the no risk opportunity for that entrepreneur is to never answer those questions and never sell his business. No risk associated. Well, the lowest risk, right?
Right.
If he's got the systems going, if he's got the customer base, if he's got the marketing, the lowest risk is don't sell, right? But $10 million of EBITDA could go for $100 million in value, and so there's no way to extract that value out of that business at one time outside of answering those questions. So entrepreneurs all the time, and you've heard of, these crazy dudes wanted to ask all these questions and this and that. Some 22-year-old came in here asking about my kid's salary. That's how you get $100 million checks, right? Beware of those that don't kind of understand that. And then, in fairness, here's the risk to an owner when they answer certain things. Not so much the kids stuff. That's just pride and ego. But, like Jay, if somebody said, hey, Elliott, walk me through your QOE business model from head to toe. I want to understand it. How do you sell? How do you market? How do you deliver? How do you do customer service? What's your net promoter score? Well, Jay, if you say you're going to buy my business and I tell you all this stuff, right? And if there's not a whole lot more to my business than the questions that you're asking, which a lot of times people don't know, I'm now giving you the playbook for my business, hoping that you're going to be a good steward of that and acquire the company. But if you don't, or you're related to my number one competitor, or you got bigger pockets than me, then I'm giving you all the secrets of my company that I now have to trust you with. So I think that's also why, and people don't get this, when there's broker deals, people don't like brokers, but brokers mean that somebody's already explained all of this to a person and they understood this risk and are still going. Whereas when you meet, people always want to talk about proprietary deal flow. Those proprietary folks have not been talked through this. There's no example for them. It can be their first time. Their perception of the risk of having, people ask those questions can be higher. So what ends up happening, and I wish there was like a chart somewhere, but those diligence processes take longer because of all of that, and they're way less likely to close. So maybe you get a benefit on the price, and maybe you're able to not deal with a broker type that people don't tend to like, but you may lower your conversion from letter of intent to close. You may lower that 4 or 5 times.
Yeah, and it's okay. So I'm going to ask you one more macro question, and then I'll go a little bit micro. So what is a good deal? And what is a good deal today?
A good deal is a business and an industry you understand or want to understand, because that's going to be mission critical. Cash flow that's consistent. You have to define consistent for yourself. Recurring's great, but hard to get. And even then, recurring doesn't make people promise that I'm going to pay you for the rest of my life. It just says for the next 12 months or 36 months. Fair price. I'm a lifestyle person, so it would need to fit my lifestyle, whether that was location wise or the kind of work that we're doing, or something else may be important in that way. Good deal. I think the question I have people ask is, can you run the business day one if the seller never answered another phone call after they took the check?
Yeah.
And I think you need to be comfortable that either you or people you could, call over to your house in a half hour could run it. So, I think, consistent cash flow, good price, business you like, or you want to know how, not like, but business you understand or you want to understand, lifestyle stuff, location can fit in there, and then you need to be able to run it.
Got it. That's awesome. And in today, where is that today's market or the nuance of today that you can add to it? Knowing where the environment we're in, the economy we're in, and all that.
So I still think prices are coming down. I think the beginning of next year, prices will be a bit better. The market will have stabilized a bit more. But you can't kind of wait until then to start looking for companies or even start prospecting, because you'll be cold.
Yes.
So I think the nuance of right now is you may need to, whatever allocation you have towards SMB deals, you may need to think about, hey, I'm pitching on deals that might be best if they come back January 1, but I won't be ready if I don't start now. It's like I want to run the triathlon in January, but I just had 2 or 3 cases of beer and 4 fried turkeys for the 4th of July, and I'm not going to be ready if I don't start now. So I think the nuance of today is that prices may be still a little out of whack, particularly for, I think, someone coming from real estate or just maybe not too familiar with the current market. But I think they're coming down, and I think there's still opportunities. I mean, I did a whole Bigger Pockets podcast, and I talked a lot about the extension of real estate professionals in business acquisitions, buying companies that they pay money to, right?
Yeah.
I mean, even like a construction company kind of fits that bill too.
And I think there are 2 things to, like, what you're saying is start now, don't wait. There will be deals, early next year, but start now. And I think there are 2 elements there. There's one where the fact that those sellers are also feeling having the same emotion that you're having, and they're trying to get ahead of it and try to sell before you get there. And then 2 is the boomerang deal that comes back, where you may put a bid on it today and not get it, but then 6 months later, it's still there to be had.
And also the sweetheart deal that, you put a letter of intent on today and maybe a price that you feel you have to stretch for, the whole market changes during due diligence, and you and the seller say, hey, it's in our best interest to cut this thing 20% and close.
Yeah.
But the reality is this game is all about reps more than any game I've ever seen played. The people who have seen more stuff are better at it. There's muscle memories that I have that will take years. I mean, I think that's why it's mission critical to have advisors on your side to help. And those aren't just get a CPA for diligence and get a lawyer for, we sort of mirror as sort of deal advisors that do QOE. Most of what we do is help people kind of Sherpa them through good deals and help them kick bad deals out quickly. Unless you know how to do that in small business acquisition, you need to find someone who can, because you're not gonna spot it as quickly as somebody who does this every day. Like you guys would run me around a real estate property so ragged, I'd be broke in 5 minutes playing around with you guys. I promise you, I'd do the same with you in small business.
So it's interesting so now that you're on that point, we had this conversation in our group around QV companies, and there was a conversation. There's always a conversation about costs when it comes to services in the ecosystem, and a couple of our guys have hired companies that are cheap, and some hired some expensive, and for me, I always think about it. There's a spectrum in terms of like quality, knowledge, and you just have to talk to a lot of providers, a lot of service providers to understand what kind of quality of earning person you have. And I explain it's the same thing as with real estate. When you hire a home inspector, not all home inspectors are the same. There's a guy that's going to give you a light report that doesn't really have much to it. And there's the guy that's going to walk you through every, corner of the house and show you where the risk is. So I'd love for you if you can explain a little bit macro, like what types of QOV companies are out there, how to kind of like recognize them, and then what is the outcome at the end, where how can you de-risk your deal in a way that you can do a good deal, because at the end of the day, it's not to pay the least amount of money for QOV, it's to get to de-risk your deal, to buy the best deal, if you will.
Yeah, there's a graveyard of people that bragged about how cheap their QOE was and went broke, right? And they're not on Twitter and LinkedIn shouting about their mistakes. I actually just did a presentation. I'm going to share my screen, Jay, because I have a slide about that exact topic. So there's kind of 3 types of QOE providers. There's the big 4 accounting folks. These are people that are auditing Coca-Cola, Home Depot, Google. You're going to pay $150,000, $250K for a QOE from them. Big deals, institutional investors. And I think these guys are great for, like, if your QOE needs to be beyond reproach and your deal is pretty large. So we're probably talking over 50 million, over $100 million. There are regional firms. I'm an Atlanta guy, so these are some of the regional Atlanta firms: Bennett Thrasher, Aprio, Moore Colson. They're going to be 50 to 125K, medium-sized deals, a little bit less institutional. They're cost-effective for a wide variety of deals, but kind of expensive. And then there's like local specialized firms. So I put myself in that. There's other firms that do that also fit into that bucket, even though they do different stuff than us. You're probably paying $25,000 to $55,000 for these reports. The difference here is these firms are more hands-on. You're going to get better white glove service. And when you want a more active partner to walk you through more than just here's EBITDA and here's working capital. And then also, these firms aren't very good, the big and the medium size, when the financials are messy, when QuickBooks isn't up to date, when inventory is on a sheet of paper, when some old archaic system is in place. And so when you need somebody to kind of dig in, which on these small deals happens quite a bit, that's sort of where you need to be. So here's like the spectrum of QOE. Tell you how I pick a partner. So if you know somebody or your friends use somebody, use them. Right. And that's not making me any money because I just met you guys. But if you don't know somebody, then try to find somebody with reviews. You can look at my LinkedIn. You can follow me on Twitter and see people recommending me. There's a website called searchfunder.com that has ratings, and you can find my ratings there. If not, think about who's speaking in the most detailed way about the exact thing you need. So if you're doing a $50 million deal, there's probably somebody who's talking about $50 million deals. But if you're doing, a $3 million deal, a $2 million deal, a $5 million deal, I'm one of the few people out there that's talking about deals that size. That's where we specialize. That's where I've been for 15 years. And we're not the cheapest. And I don't discount my price, but I think we're the best. And I think we're the best because we are the Sherpa to help people into good deals, walk them through how to get into it and how to kick them out of bad deals. And I think for most newcomers to the small and medium business acquisition space, when there's $2 million, $4 million personal guarantees at risk, where if you hear a story about somebody who's gone sideways with a bank on one of these deals, you'll read about 5 years of basically working for the bank.
Yeah.
Which is not what you signed up for. And then unfortunately, I've seen the competitors' products. I've seen people take QuickBooks, restate it, put 3 pages of stuff in there, call it a QOE, and sell it for 20 grand and not do the work. I've also seen, and this may be one of the bigger challenges for this audience. I'm a Harvard guy. I don't think I've used one big word since I've been on this thing. Now somebody call me out if I use pontificating or exacerbation or something. Most times you're going to pay for a report that you don't even know how to read. I don't think half the people read the reports that I send. What they know is when we talk through them, that I'm going to highlight the risks. And if there was something major, I would have called them already. And that I'm explaining this accounting analysis in layman's terms. Not that people aren't brilliant and probably know a bit more finance than my layman terms assumes. It's just that I'm not talking over anybody's head so they will understand the stuff. And when you're dealing with revenue fluctuations, cost fluctuations, we just had huge supply chain issues globally. When you're talking about multiples that are wonky, management teams, and all these things that you don't understand. If you get just the quality of earnings as opposed to, I think we provide a more diligence-oriented, a more broad solution, you're going to get a report that's going to say 2 things. It's going to say EBITDA and working capital. Go have fun, Jay. You figure it out from there, buddy. Well, hold on. What about what's driving this? What's driving that? Ask an accountant what's driving a number on a P&L. Yeah. And I'm going to sit there with a beer and laugh because they don't know.
Yeah. Yeah, we saw one like that in our group, a QAV that cost $7,500, and we were very impressed with the price. But then we saw the report, and it wasn't very impressive, and it was like it needed more. Yeah, so it was really interesting that you mentioned that because we've experienced it within our community already. So if we go back and dive deeper into those 3 categories that you mentioned, the financial, the commercial, and the operational. So how do you look into what's the framework in your financial, and then if we can go to the other categories. And by the way, guys, if you have any questions, please post them or ask away.
Sure. So we have a sample report on our website that you can download. You can get to it from our homepage, guardianduediligence.com. If you haven't seen one and you're interested, even though it may put you to sleep, you should still see it. But I don't charge for that ticket. So go download it. What I'll tell you is in there, Jay, and I'm going to answer your question in a second, but I'm trying to speak to the faces that I'm seeing based on my experience with people kind of understanding this. You need to know historical EBITDA or cash flow. You need to understand trends in the income statement and trends in the balance sheet. The first 7 or 8 pages of any good report is that. If your report's only 8 pages long, you missed the whole freaking bus. There's no way to deliver this in that time. QuickBooks. I've manipulated QuickBooks for clients, not maliciously, but I was chief financial officer for a friend of mine's business, and she had stuff on her balance sheet that was really legacy of her dad 28 years ago. So I had to adjust that stuff out to go get debt from a bank. QuickBooks can be manipulated. Who tells the 100% truth to the IRS when you present to them every year? Yeah, I didn't see too many hands shoot up. So you can manipulate taxes. So if all I'm taking in is taxes and QuickBooks, I can talk a big game about what I did. I ingested 2 data sources that you can bull swing. The only real believable source to me is the bank. And why is it believable? A, we all know how conservative they are. You can't run in there on January 1st and say, hey, man, no. I wanted this check for December 31st. You also can't run in there with $100 and say, hey, but tell that J dude that it's $500. So we rebuild the financials from the bank statements as our first check. It's called a proof of cash. And that allows you to say, okay, from a cash in, cash out perspective, we know that the stuff is real. Then we start looking at the QuickBooks to understand what are the trends in the income statement and the balance sheet. And then we compare it to what somebody said to the tax man, IRS. Our reports are 30 to 60 pages long. Now you may say, man, that's overkill, Elliott. I wouldn't even read all those pages, but if you're putting $5 million up, you telling me you don't want to know what's in or out of the administrative line on the income statement? Are you telling me you don't really care what's in the prepaid line on the balance sheet? Even if it's not a material thing to you, I'll tell you that out of like a 60-page QOE, and I do 40 of them a year, I could show you every single line, and I could talk about a deal where that was the thing that either made the deal the greatest deal or threw the deal out. And so having someone who's gone through all of that allows you to sift through all the crazy stuff that's just part of small business and make sure that somebody's looked at it. So I saw there's a hand up.
Yeah.
Good. Yes. Well, thanks for being on today, Elliott. So I think Jay was being humble because I know this is Go Abundance. There's a lot of real estate guys, but in this group, it's a lot of business folks that have experience buying or even selling businesses. And that's all I do full time. I've actually had a large exit last year. So I'm interested in your company. Is there any specialization in industries? I know the numbers are the numbers. And the second thing is, what was I going to say? So the industry wise and then your deal size, you mentioned like 1 million to 10 million. Can you go into that a little bit?
Sure. And thanks for that, Paul. It's tough coming in rooms and not knowing exactly who's in it. So then let me go to the more graduate level stuff. But I hope nobody's embarrassed to ask a beginner question either. So industry. I've been a generalist for 15 years. So when I was working in private equity, I was a generalist. When I was an independent business buyer, I was a generalist. Now as a QE provider, I'm a generalist. What does that mean? That means I'm not going to do some super complex oil and gas deal in Texas. It doesn't make sense for me to QOE that. I'm not doing some super smart AI technology fresh off the freaking computer. But you'd be hard pressed to send me a business model I haven't looked at before, Paul. So for us, your actual second question is really probably more pertinent for us. Size. So our average deal size is probably around $5 million now. 2 years ago, it was smaller. It was around $2 million. And I think it's just, as we've gotten better, smarter buyers have come with bigger deals. And so I think we do deals from 1 million to $30 million is probably like our 80 or 90% range. And really, I would say our customer base is really where we specialize. So we only work with independent business buyers. They're called self-funded searchers, ETA sometimes, but they're people that are putting up the money themselves, getting decked themselves, not institutional capital, not funded search funds. And so typically what that means is we're dealing with messier financials, Paul, which means we're actually getting in there, rolling our sleeves up, and like that paper inventory. So I'll give you a perfect example, because if you've done this before, you've been through something like this. You ask the seller, hey man, I need an inventory list. Oh, we don't keep inventory, man. No, we just don't do that, man. We're just, we're a mom and pop shop. We don't really do that stuff. And then I always ask people on the phone, so if I came into your lot and stole one of your trucks, you wouldn't know? Oh, heck no. Jimmy in the lot knows every truck that's in there. I was like, well, Jimmy's got the inventory list either on paper or in his head. We just need to go talk to Jimmy. And so oftentimes where I'm doing my best work is where there's mom and pop level financials, but I still need to deliver it to Paul direct answer, because I know Paul's going to ask direct questions. Like, hey man, I'm not understanding the inventory movement over the first 6 months of 2023. Help me understand that. I can't tell them they don't have an inventory list.
So how would you go back and if they can't even barely get an actual inventory picture today, how do you go back and understand the trends of that inventory?
So what happens is, in the profit and loss statement, there's going to be lines associated with inventory purchases. Sometimes they'll be expense. Oftentimes they'll be capitalized. Expense means on the profit and loss statement. Capitalized means on the balance sheet. So if I know at June 30th, 2023, what your inventory count is, now I can actually see the fluctuations because I can see the purchases in the P&L. So now I can go back to December 31st. I can go back to a year ago. Also, we triangulate data. So I mentioned tax returns, financials, bank statements. Well, you have to tell the IRS what your inventory is every year. And a lot of times you can depreciate parts of that inventory. So it's in your interest to be explicit with it. And so oftentimes that becomes a stopgap. And the other thing that, I showed like the 3 segments of QoE providers, and I told you on the right side, when the financials aren't nice, the specialized firms are better. The liability to a middle-sized firm not having the data is bigger. To me, I'm trying to deliver the best answer to Paul, to Jay, given the data set, knowing that these are, investors, grown men, and they saw this deal, liked it, and wanted me to diligence it and paid me. I'm not going to come back and say, hey, because there's no inventory list in QuickBooks, then now I'm unable to complete the work.
Yeah. So how do you,
Elliott, would you?
go ahead. No, go ahead. Sorry.
I was going to say, would you, during that due diligence period, would you make recommendations on the structure of the deal depending on the messiness of the financial statements and whatnot?
Yeah, oftentimes. So I used to work for an NBA JD, so I could play a lawyer on television. So oftentimes I'm directing the lawyers on not to spend too much time on BS, because sometimes they just run up bills on my clients. But also, hey, we found these 4 risks in the quality of earnings. You should now have reps and warranties around them and indemnity. So for those who haven't been through the acquisition process, these 90-page purchase agreements come down to price and structure in section 3, and then a bunch of reps and warranties. All those are promises that the seller says, hey, I promise you that my inventory was actually 5 trucks on June 30th, 2023. I promise you all my employees are listed on this list. I promise you, I promise you, I promise you. Then the indemnity is, hey, if I lied to you, here's how much I have to pay you back, or here's the recourse for it. And so a lot of the issues that we find in QoE then go into the purchase agreement and the reps and warranties and indemnities, and then protect the client. So you might say something like, hey, you actually need to have that list of inventory from Johnny in the lot in the purchase agreement, and you need to have the seller bet on that. And now you need an escrow of 50% of that inventory list in case he's screwing you around on inventory. So we do make recommendations.
Nice. So Eric had a question. From your experience, how do you recommend the buyer to ask questions or sniff out potential issues that are before you end up going into LOI and end up start spending money on due diligence?
It's one of those, Eric, and I don't know you, man, but I don't know how to do anything besides keep it real. It's more of an academic question.
Yeah.
And here's why. I would say pre-LOI data is like plus or minus 40%. So I would say like an 80% range. So when I see somebody that says $10 million in revenue, $1 million in a memo from a broker, I'm thinking it's probably somewhere between like 4 million and $14 million and somewhere between 600,000 and $1.5 million of EBITDA. So when you say things like sniff out, you typically in a market like this get a 1 to 10 page memo, maybe a set of taxes, maybe a set of adjusted financials. And if you're lucky, 1 half-hour call with the sellers.
Yeah.
I think what you're instead trying to do is, how do I properly assess the validity of the data that I'm getting? And I would at least do plus or minus 20%, if not my plus or minus 40%. And then really, how do I quickly post LOI get the data necessary to verify the things that matter the most?
Yeah.
So there's Jay, can I share stuff from my website with this?
Please. Yeah, please. Yeah.
So I have a post LOI page on my website. And one of the articles is how to manage a go, no go deal process. So Eric, to your question, I would answer it differently and put this into chat. That's how to manage a go, no go deal process. Here's our post LOI page. And here's where you can get the quality of earnings report. So I would say take the information pre-LOI, make a judgment call. It's plus or 20%, plus or minus 20%. State your assumptions in the letter of intent. So I have a sample letter of intent on my website too. It's under downloads. You guys can get there. And it always states the revenue and the EBITDA and the working capital that I made my evaluation based on. That way, if those things fluctuate, somebody should know that the purchase price will fluctuate in that same way. You don't really get enough data to sniff stuff out until post LOI, because I'm not giving you squat on my business until you send me a letter of intent and I think you can actually fulfill the numbers. So that's when you get the taxes going back 3 years, the bank statements, the financials. So the way you do it is in an organized way, and this is my engineer mind, but sort of, what are your deal breakers, right? So let's just put out a list of deal breakers, and you got to separate those from what I call like mosquitoes in your bedroom at night, or like somebody passing gas in a room. Like it's unsavory, but you're not going to like totally change your course of action as a result. So like deal breakers, like you might say, hey, look, I'm not doing a deal with less than $750,000 of seller discretionary earnings. I'm not doing a deal if I think the seller lies to me. So there's a lie component to this. I'm not doing a deal where you have to resell customers every quarter or every year. I need some recurring piece of this. And I'm not doing a deal if I would need to hire 3 people in the first 3 months to run this thing because I want to be a semi-passive owner. So now that I have my deal breakers, I rank them in the importance order. And then week 1, I start with the most important deal breaker, and then I diligence it. And when I get done with that, I diligence the next one, and then I diligence the next one. And so the way to sniff it out, I think, is to be formulaic in how you're thinking about it. Because if you go in and say, like, I just want a good deal and I'll figure it out in the middle, you're going to get an unsavory thing like they told you EBITDA was $1 million and it's 800,000. And you're going to lament with all your friends and everything and whine. But your deal breaker level was $750,000. So you're still within your acceptable range. And now you wasted 2 weeks crying over something that wasn't going to make you walk away from the deal.
Yeah. Makes sense. So I just remembered this question. How many deals should die in QOV? What's the percentage of deals that should die at QOV? Like a natural death, not extreme. Because I think a lot of times people get attached to the deal And then once they invest in quality of earnings, or they invest in due diligence or whatever, they invest, whether it's time or money or attention or talking to other people about the deal, they get attached to the deal. So they end up just trying to close it anyway. So
yeah, I have some articles on the website about falling in love with the deal. Be careful. It's just like high school, gentlemen. Don't do it. Just think about who that lady would have been at 16 had you proposed.
Well, we've had people that fell in love with the seller as well, and we've had people that like it happens. So so naturally, if you think of like
20 to 40% should naturally die, either because
30 to 40.
And I'm going to define what naturally die means for me. Either the numbers are totally off, the seller's a liar, there's no real business there. It's like Gladys Knight and the Pips. Like once you take Gladys Knight out, like there's no group. And so 20 to 40% are like that. And I would say inclusive of that 40. No, let me not say it this way. Another 10% are deals that have sort of drastically different revenue or EBITDA than presented, but there's a retrade that's possible to get the deal done.
Got it.
And then I'd say about 50% or so are probably within 10% of EBITDA, which means about 10% of value from day one to day close. But I still think that even the ones that they said $1 million, it's $1 million on the dot. As a buyer, you still need to know all the stuff that's in the QOE. You don't want any surprises.
Yeah.
So Adam asked a good question. Is there a stepwise report if you find a red flag and not worth completing the QOE? So I just told you that I think the recommended process is each week you go after the biggest deal breaker, and you don't close until you've assessed whether all your deal breakers are true or false. It's the same way we go about a report. So it's a 4-week process from when we get the data. Each week we're evaluating whether we should go forward or not. And then my promise to all my clients is if I find something wonky, I'm going to call you, even if it's 9:00 at night and I don't have the full story, because you may be flying to go see the seller tomorrow, you may be cutting a check for a lawyer tomorrow, you may be taking your wife to the company. And so I know the urgency of data in this deal process because I've sat in my client's seat. So we do have a stepwise report. We don't have like 10 different sections that you can pay for separately. You guys are all business owners. But we're not so popular because we waste people's time. So one of the biggest things for me when I was on the deal side was you get a deal, you think it's $1 million of EBITDA, and it ends up being like $500,000. The accountant sends you that information 4 weeks into the process. And I'm looking at a CPA like, you didn't know that for 4 weeks? Really, dude, you didn't know that for 4 weeks? So I don't surprise my clients. And sometimes that puts me in a weird spot because people stop the process early, but I think it's best for the business and best for the landscape. A lot of people come back in that scenario. He also mentioned, Adam, in the questions, a Sherpa program. So we haven't officially launched it, but it'll be launched the second half of this year. So the Sherpa program essentially is ushering somebody from LOI to close in a more done with you, hands-on way. And if you're interested in that, my email and contact information are on my website at the bottom. Reach out and I can tell you more about it.
You do stuff pre-LOI too. I think I saw on your website that you can actually look at stuff pre-LOI.
Yep. So I really tried to design this to be as helpful as is reasonable without engaging with too many folks that aren't serious. And you're all business owners, so you get that. So my pre-LOI program is set up this way on purpose. So it's a $2,500 investment, and what you get is 10 hours of my time to work on any sort of pre-LOI deal situation. So I've worked with people on deal evaluation matrices. I've worked with them on negotiating letters of intent. I've worked with them on writing them. I've worked with doing sort of upfront financial models. I've worked with, hey, Elliott, I'm looking at these 8 deals. Which are the best ones? I've worked with, hey, I'm thinking about moving halfway across the country. Talk to me about it. I've been a therapist probably a couple of times. but it's a $2,500 investment to get 10 hours of that time. And then what's nice is for anyone who converts to a quality of earnings client, it's actually free for you because I take that money off the quality of earnings. So it's a way to engage earlier in the process if you want the help. And then if you work with me on QOE, it's free. And if you don't, it's a small investment. And the reality is most people who know what I know as a deal professional aren't available at all to help you on any paid mechanism. So it's a very unique opportunity in the ecosystem of small and medium deals.
Nice. No, that is smart. So I just want to squeeze in a couple last questions before. When you have commercial risk, where have you seen some of the commercial risks out there, and how do you retrade it in the contract? And then we had the operational risk. How do you where are the main operational risks, and how do you retrade for that?
So I'm dealing with a client right now who is buying a distribution business that supplies hotels in a certain part of the world. I won't go any further than that. And their biggest customer is a hotel that a lot of people know. And the story that's been told is, although 30 or 40% of their business goes to this one hotel, that it's actually 6 or 7 buyers in that hotel that act independently. Now, Jay, I don't believe it either. But you asked about commercial risk. This is commercial risk because that property changes managers, if that property gets hit by a hurricane, if one of those 6 people ends up not liking the business, they all eat lunch together. And so let's say that you thought it was 6 customers and you got comfortable with that revenue disbursement, and now you realize that's 1 and you're not. You would need to just retrade. And I'm going to actually write a Twitter post about retrading this week. But essentially what you have to do is sort of say, hey, look, if what you said was actually true, I would have paid you what I said I was going to pay you. It's not. And so now I have a concentration risk. The best way to handle concentration risk in my mind is a bigger seller note. So now maybe I can get to the price, but instead of a 20% seller note, we need a 45% seller note. Because if you know that client's going off, and that's why you're trying to sell it to me, I won't know until after I bought it. And then the thing's only worth half of what I'm paying for it. If you're right and it's the greatest customer ever, then I'm going to end up paying through the seller note. So this is how we sort of bridge the gap. On an operational basis, the example I tell all the time is sort of every owner says that their head of sales does all the selling. But a lot of times you can sell because the old man's still in the seat, right?
Yep.
Or the client went to high school with the old man. And so you got to be really careful from an operational perspective. You think there's a CEO, accounting and finance person, and then like a salesperson. You think that salesperson is driving the sales. So you're asking that person sales questions when really the owner who's leaving is the salesperson, and that's just their admin.
Yep.
And so that would be another one where you'd get in and say, hey, look, you don't really have a transferable sales office here. So, I said I was going to need you 10 hours for the first 3 months. I'm actually going to need you 15 hours for the first 6. And I need you to write a training manual on sales. And we need to introduce me to half the salespeople or half the clients and create active conversations for you to get 30 or 40% of your money. You have to figure out some way. I talk about make the seller bet with you. I don't bet against sellers, bet with them.
Yeah. Got it. I appreciate that line. That's a really good one, actually. Making the bet with you, not, against you. Yeah, I appreciate that. Well, I don't want to take too much of your time. Thank you, Elliott. I really appreciate it. I will put your contact information in our group. I'm 100% sure you're going to get connection with our guys. And hopefully we'll bring you back to, again, in a few months if you have time. So I appreciate it. Thank you very much.
I'd love to come back, Jay. Don't be shy to ask me. I enjoyed it, guys. Thanks for the questions. And I'm sure I'll be talking to some of you soon.
For sure. Absolutely. Thank you. Appreciate it.
Okay.